I think we're kind of at the beginning of this. If you just do the basic arithmetic, if there's 10 billion in DeFi now, and there's 350 billion that could be in DeFi, and you're looking at 2 to 8% interest rates, you have two serious forces pushing things into DeFi.
In today's video, I want to talk about my favorite cryptocurrency, apart from Bitcoin, my favorite cryptocurrency, which is Chainlink. So why is Chainlink my favorite cryptocurrency? It's because it is extraordinarily useful and has extreme fundamental value. And also on a technical level, it also looks really, really strong. But I'm more interested in the fundamentals of any project. So the fundamentals with Chainlink are enormous. So I'm going to bring up this quick slide here. So in the beginning, there was Bitcoin, and we can see Bitcoin was extraordinarily useful as a store of value, a way to store your money away from governments, and no, it's censorship resistant, etc., etc. We all know that. Next came Ethereum, which Bitcoin you can't really do much with, but then comes Ethereum, and Ethereum is much more programmable, and you can implement smart contracts and dApps and all sorts of fun things. So Ethereum allows for a lot more use cases than Bitcoin. However, Ethereum doesn't allow you to connect with the real world with real world data. That's where Chainlink comes in. That's the third layer of cryptocurrency or blockchain technology that is extraordinarily required. Chainlink allows you to feed real world data in a decentralized manner into a smart contract. So maybe I should explain what a smart contract is, or maybe I should get big Sergey Nazarov to explain what a smart contract is. He is the CEO of Chainlink, so I'll let him take it away.
So smart contracts in the simplest terms from a user's point of view are math-based contractual agreements. And I think the way to contrast them is to think about brand-based contractual agreements. And this will highlight for people the notion of something called tamper-proofness and the usefulness of tamper-proofness. Because a lot of the times blockchains are explained in these technical parameters of tamper-proofness and reliability and censorship resistance and immutability. And these concepts don't always transfer over to use cases. So the thing that I think is needed is an understanding of a contrast between how the world works today and how the world will work in a math-based agreement kind of world. So the thing that people maybe don't think about so much because it seems to be working or it works in certain cases and so it's good enough, is that the agreements they have around their bank accounts, their assets, financial instruments are really brand-based agreements. And what brand-based agreements are a logo. There's a logo on a building somewhere. Just like in the Wild West, the biggest building was the bank with the pillars, and everybody would, put their money in the bank with the pillars because it would have the really nice pillars and be really impressive, and it would be the nicest building, nicer than the church, right? And that was the brand-based guarantee that bank gave you in that kind of gold mining town. And things haven't really changed very much in reality over I would even say hundreds, maybe even thousands of years, where you basically have a brand-based guarantee, right? I have a logo. My logo represents an institution or an entity. My institution or entity has been around for X hundred years. And I guarantee to you on paper, on a paper document, that my relationship with you is such that your assets or your financial product or the value you hold in my institution is within your control, right? Like you will be able to access it. You will be able to buy and sell financial products. You will have a savings account that you will always be able to access. All the money in your savings account, you can always access. All the money in a trading account, you can always trade and you can always liquidate it whenever you want. And like all these types of guarantees are foundationally based on a logo. They're based on, I exist for a long time. I will continue to exist. I'm guaranteeing to you that this relationship that I manage for your value that you hold with me will function in a certain way, right? And so those are brand-based agreements. Now, what math-based agreements do is they basically say there is no brand, there is no thing that has existed for hundreds of years, and I promise you things will work a certain way in a paper document. There is just math. So there's cryptography and mathematics that guarantees at the level of physics and mathematics that you have a certain relationship with a certain asset, certain financial product, certain contract.
Now you kind of understand what a smart contract is. It's a math-based agreement between two parties. So you don't have You don't need to trust anyone. It's just a mathematical, coded, programmed agreement between two parties that when certain conditions are met, the contract will be carried out. So brand-based agreements and brand-based trust work well until they don't work. So you can see that, for example, with Robinhood recently and the whole shutting down GameStop, halting trading on GameStop stock recently. Or you could see that with banks in Cyprus shutting down and only allowing customers to withdraw 60 euros per day or something crazy like that.
If you had a choice, do I want a brand-based agreement where the insurance company might pay me out or might not pay me out? Or do I want a smart contract that guarantees me payment if something happens? Every rational actor would choose the math-based smart contract. And that's the guarantee that smart contracts have, which other systems don't. Whether it's financial products or savings accounts in emerging markets where people wouldn't usually have a savings account to combat inflation, or even whether it's more advanced contracts within developed markets where you're properly managing the risk around transparency and mortgages and all these types of things, right? So I think that smart contracts are this tamper-proof, mathematically guaranteed contractual agreement, but they're mathematically guaranteed specifically because they're run in these networks of computers that are run in a very specific way. And this is what decentralized infrastructure means. Decentralized infrastructure equals math-based guarantees. Anything other than decentralized infrastructure means brand-based guarantees.
So what's the point of Chainlink? Why do we need Chainlink? Well, it's been estimated that smart contracts, 80% of smart contracts need real-world data to facilitate their smart contracts. For example, a couple of examples of data they might need: price feeds. So this is something that has actually screwed over a couple of exchanges and resulted in multi-million-dollar hacks. So basically what some people did, they were going on to decentralized exchanges, seeing that the price of one cryptocurrency on one decentralized exchange was one price and it was a different price on the other. So they were just taking out a huge loan, buying loads cheap here and selling it there. So it's basically arbitrage, but because it's on decentralized exchanges, no one is controlling it, only Mats is controlling it. There's nothing that can be done about it. However, the decentralized exchanges that use Chainlink don't have this problem because they're getting accurate price data from their nodes. So I'm going to try and explain how the Chainlink system works in shortest amount of time that I possibly can. So basically there's a decentralized set of nodes, so decentralized set of people or groups who are feeding the Chainlink data system with accurate data. So the more accurate the data that they feed the system, the more that they'll be paid in rewards, the better their reputation will become. And then the better their reputation becomes, the more money that they'll make. So maybe let's start with an example of a smart contract and then a node operator. So let's say I'm a farmer in sub-Saharan Africa and I rely on getting at least rain every once a week or something. Otherwise I won't be able to grow my crops. So obviously I'm highly reliant on the weather, and if there's no rain, I'm completely screwed. So I want to set up some insurance for myself in the case that there's a drought, because if there's a drought, I will go out of business and I'll probably starve. So let's say I set up a smart contract of insurance. So if there is no rain for 2 weeks or 1 month or something, or whatever conditions that there's no rain and I can't grow my crops, that I will get paid out so I can still survive. So I'm obviously going to be paying insurance premiums. So every once a week or once a month, I'll pay a set amount of insurance. And as long as I'm paying that insurance, my smart contract is still valid. But then there's no rain for a month. Smart contract realizes that there's not been rain for a month and will pay out the insurance premium to allow me to live and not die. So how does a smart contract know that the data it's been giving about there not being rain in 1 month's time, how does it know that it's accurate? So if it was just coming from a centralized system, so from one weather system place that measures the weather, that's a attack point. That's somewhere where the insurance contract could be manipulated to give out an insurance premium, because this is just a smart contract. It's not a company that can decide like a human could. So this is just a smart contract. So what you need is a decentralized set of nodes who all independently measure the weather forecast or the weather and then feed the data to the smart contract in a decentralized fashion. So if everything's decentralized in the entire system, then the smart contract is pretty effing close to foolproof. So say this is a $100,000 contract. This smart contract is worth $100,000, meaning if there's no rain for a month, the smart contract will pay the farmer $100,000. The way to incentivize all the node operators, so there's me giving weather data, there's some other bloke that I don't know giving weather data, there's someone else giving weather data, etc., etc. The way to incentivize us to give accurate real world data is to make us stake money or make us stake Chainlink. So for me to give data for a $100,000 contract, I would need to stake $100,000. So in the event that I'm giving fake data, I will lose $100,000. So that's what gives the Chainlink token value. All the node operators need to own Chainlink to be able to stake it, to actually make money from the Chainlink ecosystem, and they will also be getting paid in Chainlink. So that's kind of the Chainlink tokenomics. So the idea of me having to stake $100,000 is, say I only had to stake $90,000, I can make a deal with the farmer and say, oh, I'm going to give fake data, and then I'll lose my 90,000, but you'll get the 100,000 and we'll both split the difference. So there's the reason that all the node operators should stake the amount that the smart contract is worth, so there can't be any exploits in the system. So that gives the Chainlink, so that requires everyone to actually own Chainlink. So that's why Chainlink's price is being going up so much. Also, the entire system is paid through the cryptocurrency Chainlink. So the node operators get paid for giving accurate data, and the better their data, the more that they're going to get paid, the better reputation that they'll have, because people see, oh, this node operator has always given good data, so we want to rely on him. If it's a $100 million contract or a $1 billion contract, we really need really highly accurate data sources.
Like, for example, if I have 100 sensors all telling me that the weather or the rainfall or something is in a certain state, I have a certain level of proof that I can pay out an insurance policy.
Right.
And so now I can automate that payout of that insurance policy. And if I can automate the payout of the insurance policy, well, then guess what? I don't need a local legal system to enable insurance. I can have a parallel technologically enforced legal system that'll provide crop insurance to people on their phones in all parts of the world where it might have taken them decades to get crop insurance against droughts and weather events and all these things that impact all these people farming.
So smart contracts could completely replace the legal system in the future. In 10 to 20 years, we might need lawyers, and you know how much lawyers charge and how much you need to pay if you want a solicitor for an hour or two. It's like a few $100s. Smart contracts could reduce the need for legal systems, completely replace an enormous amount of contracts that are currently being signed in the traditional way. Also in places where it's extremely hard to get insurance, authoritarian governments where everything is there's a lot of red tape that you need to get through to get anything done. With a decentralized system, you don't need any permission. You can just straight away get insurance. You'll get a quote for insurance in a decentralized fashion, and there's no one who can stop you. So particularly in the third world, Chainlink could be extraordinarily useful.
There's a huge amount of things and that can be proven with data, and the amount of them is only going to increase. And the global financial system and even emerging markets are all going to want and need a contractual system that functions in a provable, transparent, and efficient way. It's not about speculation. It's about, here is a financial contract that works better. Whereas the standard normal financial system might give you 0% or 0.05% interest, or if you're lucky to get it, 1% interest or something, right? And that's probably going to persist, and inflation is probably going to happen pretty heavily. This ecosystem can give you anywhere from 2 to 8% interest consistently.
Not only could the legal system be replaced, but the entire traditional financial system is looking like it could be easily replaced by decentralized finance. Lending, borrowing, mortgages, buying stocks, options, etc., etc. All this could be done in a decentralized manner, which is more efficient, less trust required. So the question that would be posed to all of us in 10 to 20 years is, do you want to place your trust in this bank, or do you want to place your trust in this mathematical smart contract? So what this means is that every single current traditional bank is either going to have to implement smart contracts into their business, because everyone's going to prefer math-based contracts in the future rather than having to trust a bank. Like, they want 100% guarantees that their money is safe rather than their money is based in trust in this fancy building. So any bank or financial institution or legal system that doesn't offer a smart contract is probably going to be replaced in the future by the systems that do. So you're probably wondering what price I think Chainlink's going to go this year. Well, I don't have a crystal ball, but I'd say anywhere from $250 to $1,000 within the next year. But over the next 10 years, what I'm going to be holding it for, the sky is the limit. Like, I have no idea what price this could actually go to in the future, because Chainlink is necessary for every transaction within the Chainlink ecosystem. If you want to connect smart contracts, legal systems, financial systems, any sort of decentralized financial, decentralized legal systems to the blockchain, you're going to need Chainlink in every single facet of that transaction and smart contract. There's going to be Chainlink needed to be staked, Chainlink needed to be transacted, Chainlink needed to be paid to the node operators, and Chainlink needed to be paid out to, I don't know, the smart contract client. So it's extraordinarily hard to determine how much value this token could be worth in the future, because it's not like the same as valuing a company that has a price to earnings ratio. This is completely determined on adoption, and we can already see how fast the adoption is in the DeFi space already. We already have like $30 billion locked up in DeFi from basically zero a year ago. So it's absolutely exploding, and these all require Chainlink, as I mentioned before.
I think we're kind of at the beginning of this. If you just do the basic arithmetic, if there's 10 billion in DeFi now, and there's 350 billion that could be in DeFi, and you're looking at 2 to 8% interest rates, you have two serious forces pushing things into DeFi. The first serious force is, who doesn't want 2 to 8% interest on an asset?
Right.
And then the second serious force is, eventually the consumer landscape, Robinhood or whoever is going to figure out, everybody wants interest yields. If all I have to do to get somebody interest is take their dollars and turn it into a stable coin and put the stable coin in a lending protocol, and I can suddenly give them 4%, a 4% savings account. I mean, how do you think that's going to play out in the consumer market? And how much value, like, why on earth wouldn't trillions of dollars in value eventually flow into an environment like the financial markets don't care. Like, they don't care what infrastructure they use. They don't care if their 4% yield comes from a database running X software or Y software or a blockchain.
I think it has one of the most fundamental use cases in the blockchain system. So I think it's similar to Ethereum in that it's highly required to do anything on the blockchain. You kind of need Ethereum and you need Chainlink. So that's why it's kind of also a safer bet within the cryptocurrency space. So that's everything I wanted to say for this video. I really hope you enjoyed it. If you did, please smash the thumbs up button, subscribe if you haven't already, and I really hope you learned something, and I hope to see you in the next one. Cheers. Bye.